All right, this is Patrick Rogers, and today we have the privilege to have Wayne Zell on the show. And Wayne is the CEO of Zell Law. Welcome to the show, Wayne.
Thanks, Patrick. Thanks for having me on the show.
Absolutely, man. It's great to have you. I can't wait to dig into everything. So, a little bit about Wayne. He has been advising clients for 37 plus years in business, tax and estate issues. His clients include wide range of entrepreneurs, institutions, I know high net worth individuals, tech companies, real estate developers, construction, investment advisory firms, and so on. He loves guiding his clients through their business formation, growth, and really exit strategy. He's been an architect of hundreds of transactions and really helps his clients make millions more than they would have otherwise. His passion for helping entrepreneurs build their succession plan. He actually wrote a book called Your Multimillion-Dollar Exit, an entrepreneur's business succession planner, which came out in May of this year. He has created a series of interactive workshops based upon the book for presentation to entrepreneurs and family-owned businesses across the country. He speaks frequently to entrepreneurs, financial planners, accountants, and high net worth individuals. Active speaker and writer, Wayne is actually recognized as one of the best lawyers in America. He also hosts his own podcast, the Blueprint for Wealth videocast, where he interviews entrepreneurs on their unique stories, many of which are included in his book. And I know we're going to talk about that today, Wayne. And today he really uses an expertise and experience to help entrepreneurs successfully architect the best exit from their business. And so, Wayne, I can't wait to dive into all this because as we talked about, I was actually in my previous life a certified exit planning advisor, and we play in the same field, M&A, together. So I can't wait to dive into it. I'm excited for our call. Before we dive into all of that, what's one interesting fact about yourself that not many people know?
This is a good one. From the age of 16, I used to write music. And so I was a music composer, played piano, and mostly sang. Did it heavily all the way up until age 30, and then took a breather, and then wrote some music in my 40s, and then again in my 50s. But it's been a while because I'm in my 60s now. But I've got a bunch of stuff up on Spotify, and things that I wrote and recorded as demos at the age of 17 in a recording studio at the end of summer before going away to college. So I was able to salvage all these tapes and put it up on Spotify. Some of it's pretty good, some of it's really crappy. So
Okay.
You never know. You never know.
Well,
So,
first of all, you look hella good you said you're 65?
yep.
Oh man, you look good, dude. I would have
Thank
guessed
you.
you're 50s. So good
Oh,
on you.
thank you
Number
so
one
much.
there.
You're my
The
best
music-
friend.
There we go. The music thing, man, that's awesome. That's near and dear to my heart. I actually just spent the last week in recording studio with my dad, helping him get some of his songs, down and recorded. But that's so.
Cool.
What kind of songs do you do? What kind of music?
I guess early on I was influenced a lot by, Billy Joel and Elton John, piano-oriented
Yeah,
music.
yeah.
Uh, some of it's spiritual, some of it just, life-driven, blues, things like that. And my own style. Nothing, I don't think it's anything that would ever hit popularity, but there was some good stuff in there that if you ever do, look me up on Spotify, you might enjoy a couple of the pieces that were up there.
Okay.
So
Awesome. Yeah, I'll definitely check it out, man. So tell us more about your journey with Zell Law and where you're at now.
I've been practicing law for a long time, and I'm still trying to get it right. So 37 years later, I started with big firms, and then I went back into the accounting world where I had started my career in 1980. I was with Arthur Andersen and Company. I worked for Price Waterhouse, Coopers and Lybrand. Then I went to work for different law firms. And finally, probably at the age of, it must have been around 43, I started to think, I am an entrepreneur and I want to go out and do this on my own. So I started up Zell Law Part 1 back in 2004, sold it to another firm in 2011, worked for that firm or with that firm for about 8 years and left, and then restarted Zell Law Part 2 in 2019.
Okay.
And we're up to about 10 people, 4 attorneys and paralegals and professionals and all that kind of stuff. So, and it's a law firm. Then I also have Aspire to Exit, which is a business exit planning firm that is not a law firm, where I exercise my business exit planning skills that I've been certified in. So.
Yeah, very cool. Awesome. So, I know you're kind of honing in and focusing on exit planning now, and that's where you spend the majority of your time is really helping entrepreneurs there. I know we're going to get into the book too. So, most CEOs out there, Wayne, they're running their business and they're just all forces ahead. I'm working on strategy. I'm working on who's my next hire. I'm working on culture. I'm working on sales. I'm working on marketing. Man, the last thing that most of the entrepreneurs that I run across are thinking about is an exit plan. Well, why is it important for entrepreneurs to start planning their exit at the beginning of their entrepreneurial journey?
Stephen Covey, the famous author and managerial expert, said you always have to start with the end in mind. And
Mm,
you should. If you don't, you could leave not only money on the table, but you could leave your family destitute. So thinking about the unexpected is important. So that's where the estate planning comes in pretty heavily. But there's also a business succession plan, a management succession plan that you can link to your estate planning so that it's all coordinated, all integrated. So if you're disabled and you can't run the business any longer, you have a stroke or you're at the age of 55, you might die. There's an example in the beginning of the book, in the introduction to the book, where this, a real life story happened. And what do? The family calls you up and said, what do I do next? You should anticipate that and plan for it and have it in place. It's not only business continuity planning, but it's also putting in place who your successors are. And if you don't have them, start thinking about that today. So that's
mm,
the unexpected.
mhm.
And then you're going to maximize the value of your business, as you know, as a business exit planner, as
Yeah.
somebody who's an expert in acquisitions. You're going to maximize the value of the business. If you filled in all your value gaps and you've got a good management team to run the business after it's been sold, if you're going to sell it, if that is your exit, or are you going to sell it to your family or transfer it within the family, or are you going to transfer it to the management team through a non-qualified transfer,
Right,
or
right.
you're going to do it through an ESOP? I mean, there's so many ways that you can exit your business. And yeah, you're not going to have the definitive plan in mind today, but work with an exit planner and you can actually define when you want to get out,
Mm.
for how much you need from the business to live comfortably, or how much your family's going to need. And have you done all the planning in between to take care of everybody, whether it's doing life insurance planning, disability insurance, having the right management team in place, having the right skill sets in place to run the business? I can't tell you how many entrepreneurs I work with who own 100% of the business, or 50% or 70%, whatever it is that they own.
Yeah.
They don't think about it. And now I'm out on the speaking circuit because of this book, and I'm getting a ton of business simply because people haven't thought about it and they realize that they need to. So working in the business is not necessarily working on the business. And we want to make sure that people are working on the business, including the business exit, from the beginning. It should be considered from the beginning.
So let's say I'm a business owner and I mean, you and I both know we're in this industry that baby boomers are exiting in droves, right? And
Yes.
there's a lot of baby boomers who are looking for retirement. What do you say to those guys who, they got 2 years left, they got 3 years left, and obviously, hey, I would imagine what you're going to say is you need to talk to me, right? But what are the main things that you would focus on if I got 2 or 3 years left and I've done nothing for business exit planning? What should I be really keying into?
Well, I guess the first question is it really 2 or 3 years, and why? Are you sick? Are you going to die in 2 or 3 years? Do you have to retire at age 65, even though that was your plan? And if you have planned for it, what resources do you have outside the business? So have you done financial planning with a personal financial planner or a certified financial planner outside the business?
Yeah.
Outside the business? And what resources are you counting on from the business to live on,
Mm,
so that your family is taken care of, you're taken care of, you can achieve your retirement goals? So it's combining the personal financial planning and estate planning with your business planning, which most people don't think about. And so, do you need me? I don't know if I'm going to be able to help you, but those are the things that I would be focusing on first. So when do you want to get out? What's the date? Oh, I want to get out December 31st, 2027. Okay, fine. When you get out, what do you hope to get from the business? Are you going to close the business down? Are you going to sell it? Are you going to keep it running? Who's going to keep it running for you? How much money do you need out of the business, salary wise or consulting fees? Or are you going to sell it? If you're going to sell it, what is the benchmark that you think you're going to sell it for? And how did you come up with that value? So there's a variety of things that go into, as you know, when you're doing business exit planning, is you got to know what the business is worth today. You got to know what the business is going to be worth or should be worth at the end of 2027 when you want to get out. And how do you fill that value gap if there is one? How do we get to that number that you need to retire comfortably? And if you can't get there, what can we do now to enhance the value of the business to get you there? How can we fill in these value gaps? And what are the value drivers in the business? What are the things that make the business more valuable? And there's always things that buyers are looking for, because you represent the buyers. They're looking for a management team that can run the business. Is there transferable value? Meaning that if you leave the business tomorrow, is there something that can be transferred over to the buyer that is worth what the buyer is paying for? And if not, the buyer's not going to pay as much as you think they're going to pay if you're not going to be involved with the business.
Okay, so I love that you're talking about these value gaps and these transferable value amounts or value items. So besides a management team that can run the company, and besides obvious things, right, assets that are in the company, what are some of these other value gaps and ways that the owners can enhance the value that's transferable?
Well, keeping the management team in place is important. So have you incentivized them properly? And do you have incentives in the form of retention bonuses or stay bonuses? Have you offered them equity? So that's one thing that I always look at is, will they participate in the ownership of the company, and how? And how can we do that on a tax efficient basis? Number one. Number two, what are the things that make your business unique from your competitors? And what are the value drivers? If you're a service business, the people that work for you are going to be absolutely critical. So it's not just the management team, it's keeping your staff, your people on board. If you're big enough, how do we keep them incentivized and focused? And so what are your values? What operating systems are you using? What processes do you have in place and policies do you have in place, so that the buyer is basically inheriting a turnkey operation that hums on its own? If it's missing a piece, what piece is it missing? Is it missing a good marketing piece, a good sales piece? Is it missing a good manufacturing piece if it's a product company? Is it missing a good distribution piece and logistics and operations? These are all things that I'm not an expert in all that stuff, but the key is to bring in the right people to identify how to fill those value gaps properly, efficiently in the time frame that you've laid out. So in doing a business exit plan, you want to figure out what the value drivers of the business are, whether it's sales, marketing, manufacturing, staff, keeping the staff incentivized, whether or not you have diversity of customers, diversity of vendors. All of these things impact the value of a business. The more diversity of customers you have, the more diversity of vendors you have, the more longevity your employees have in the business, and the more stable your management team is and capable of running it without you. Those all add to the overall value of the business. Of course, what the earnings of the business are going to drive the overall value. But again, will those earnings sustain themselves after you're gone? Earnings before interest, taxes, depreciation, amortization, EBITDA, and what kind of multiple can you attract on the sale of your business? And is your multiple real? In other words, are you going to be able to get the multiple you think you can get because your friend down the street sold his business and his roofing business or whatever it is for a multiple of 6x or 7x? Can you get that?
Yeah.
And are you the same? And
So
not.
so when you talk about that multiple, right? I mean, you could have two roofing companies, right? Roofing company A, roofing company B. Let's say they both have an EBITDA of 2 million. But if I'm hearing you correctly, the one with a 2 million of EBITDA here, but has all of these operating systems in place. The business runs by itself, a management team has SOPs, unique value proposition, the staff is incentivized. Same EBITDA, but this one's going to sell for more, right?
I think so. I think it should,
Yeah.
because the buyer has to do less to learn about the business, to integrate it with its business. It will allow the, particularly if you're representing a private equity fund or somebody that is looking to invest in a business, that business can move and operate successfully on its own. Whereas if you don't have a lot of those systems in place, or you haven't documented the systems, are you really worth what you think you're worth from a financial perspective? In other words, how much is the buyer going to have to invest to integrate that business into its business if it's a strategic buyer? And if it's a financial buyer, is it going to be able to operate on its own successfully? Does it have everything in place that all the buyer's doing is buying the business, as opposed to buying the business and then having to invest significant dollars to make it even more successful? So
Yeah.
those are always questions that, have
Yeah.
to be asked.
So, we've been in a pretty unstable economic environment for the last few years. We've been all over the place, up and down, and there's a lot of talk of us potentially going into another recessionary year next year. What's your advice to entrepreneurs who are kind of worried about that with respect to timing and selling my business? What are your thoughts about that for where we
Great
are now?
question. The market for M&A, as you know, is turned down in 2022 compared to 2021 and even 2020 when COVID was around. I represent a lot of government contractors over time. I've, sold probably 3 dozen. And what we've seen in recent months, particularly since January of 2023, is that things slowed down. Things have slowed down, not to a halt. There are deals still happening, but that's the interest rate increase in the environment has caused buyers to have less capital available at reasonable rates to afford the purchase of a business and make a good return on investment for its investors. So because interest rates are high, it tends to curb the enthusiasm for M&A activity. If we do hit a recession, that means values will suffer in the M&A environment, even more than they have suffered. So higher interest rates reduce values in the marketplace generally, unless you've got a business that is generating incredibly good margins and growing at an incredible rate. So I've got one government contractor I'm working with now. He's growing at a rate of 30% a year, even in this environment. And it's because of what he's doing and how he's doing it. And so I think, it all depends on the business itself. If you're growing and you're growing fast, you could exit even during a recession and still make a good, profit on the sale. So it's really not what the economy is doing, is what is your business doing in light of the economy. Now, if we are in a recession, there's going to be less interest in your business, and you may not get as much of a markup on the sale as you would if you wait until we emerge from it. So a lot of clients are waiting. They're saying, I'm going to use this time to grow my business as best I can, even in a supposedly down economic environment. All indicators are, though, that if we do have a recession, it's going to be a very soft landing, and we'll be emerging from this, according to economists recently. Now, that could change. Any event, Russia invading China, or China invading, Taiwan, or something like that could send the markets into a tailspin. But all that stuff, with all that said, may influence values. And of course, you could have tax increases that would cause sellers not to be as willing to sell. If the Democrats were to hold on to the presidency and take over the Congress, they could do away with capital gains rates like Clinton did in the 1990s. But again, he also balanced the budget, and he did some things that were beneficial to the economy. So whatever your leanings are, Democrat, Republican, or otherwise, I think there are things that could happen that could have a chilling effect in the short term on the market. But in the long term, we're in the United States of America, and if we don't all succeed on over the long term, no one's going to succeed.
No
So
one's-
that's the way I look at it. So if from a recession standpoint, yeah, you maybe want to be cautious in trying to engineer a sale. I've got another client who's a software developer. He's growing at, again, at an exponential rate. We had a valuation done. The valuation came in pretty low compared to what they think this is going to sell for. And they probably will sell either this year or next, even in a recession, because of what they're doing and how they're doing it and how fast they're growing. And so the client will be tickled if they get what they think they're going to get. And based on what investment bankers are saying, they will get a huge multiple on what the company is currently worth. So there's all kinds of planning we're doing now for them as a result.
So, yeah, and I 100% agree. I follow ITR Economics. They're kind of a, a company that does modeling and forecasting on a macro basis and micro, and definitely in some industries. But they're saying that very similar to what you had said is, yeah, we're probably going to be entering a recessionary year, but it's going to be a soft landing, and they're expecting a pretty turn quick around by 2025. Things are going to be off and running again, and so I think, the economists that you're talking to and hearing from are saying very similar things. Um, so Wayne, when it comes to like taxes and businesses, on a personal side of things, I know a lot of professionals like to talk about, and you had actually talked about it too, like the irrevocable trust. How does that play into business exit planning and taxes for you and your clients?
Yeah, so I do work a lot with ultra high net worth entrepreneurs, and most of my clients are entrepreneurs. It's not legacy wealth that's inherited from generation to generation, although they're creating it now so that it can be passed on. So if you look at a business, and let's say it's valued at $30 million today, but they think it's going to sell based on its growth rate for 300 million. You should be doing some planning today to try to shift some of that wealth out of your estate without losing complete control of it. And you can use irrevocable trusts to accomplish that result. You can also use limited liability companies coupled with irrevocable trusts. Some really creative techniques that we use. By transferring a piece of your business today, you can claim a discount on the value of the business, which is because the business, it might be a minority interest in a closely held business that's not marketable. And so the discounts range from 25 to 40%, depending on the
Wow.
business and the valuation expert. So that discount in and of itself is being transferred out of your estate permanently at a rate of 40% federal. So if you were to transfer $10 million of value that can be discounted by 30%, it's only valued for a gift and estate tax purposes at $7 million. That's a $3 million discount at 40% is worth $1,200,000 to your family. That's a no-brainer. So we should be doing that for everybody now. If and when the law changes, that may not be permissible in the future. But today, it's totally permissible. President Trump revoked regulations back in 2018 that would have done away with the ability to use valuation discounting. And then on top of that, all the appreciation. So the example I used, let's say I transferred 20% of a $30 million business that would normally be worth $6 million. We're going to discount it. Now, let's say we sell it for 300 million, the business. That 6 million is now worth 60 million. I've moved $54 million of assets outside of my estate at a 40% savings federal. Good gracious, that's what, $21.6 million of tax savings that we've saved for your family. And it doesn't go to Uncle Sam, it goes to your family in the future. And we can do that from generation to generation using dynasty trusts. So all of these techniques are still available. Again, the Biden administration tried to shut it down back in 2021. The House Ways and Means Committee passed a bill that would have shut it down, but it never reached the House floor because there are too many House Democrats
Too many
that
Democrats that
did
have these
not
trusts.
want to have that happen either. And so, and the Senate never got to that. And so we still have these very valuable techniques in an era of high tax exemptions to use before they drop at the end of 2025. So we're really busy trying to transfer wealth for entrepreneurs today before the exemptions drop automatically at the end of 2025 by 50%, which is also part of the Trump legislation. A lot of people don't focus on that. They say, oh, we don't have to worry about death tax. The exemption's $12,920,000 a person this year, and it's going up to $13.5 million next year. That's true. But at the end of 2025, excuse me, it drops by 50%. So if you don't use that extra exemption, you lose it. So that
Wow.
for our clients that have valuable business assets, this is becoming a really big focus, and using irrevocable trusts to transfer a piece of the business interest to is a very valuable planning tool. And these
Love it.
trusts are very cool. They can work in a variety of different ways that provide asset protection as well as tax savings.
Absolutely. Absolutely. I love it. That's worth the price of admission right there.
And
Well, hey,
that's just part of what I do. I mean,
yeah,
that's
that's
the
one small piece.
pre-transaction planning that you want to do as an entrepreneur.
Yeah.
And if your business is not worth that much, you don't have to do that stuff. But there are other things that you should be doing, like the management succession plan and putting your stock or your company into a revocable trust so that it avoids probate if you die unexpectedly. We don't want to have to go through the court system,
Yeah.
which again depletes assets for your family and causes delays unnecessarily. And I can't tell you how many times I've advised clients to do it and they say, oh, I don't have to worry about that right now.
Yeah.
And then something happens and then they regret it. The family regrets it. So there's never a bad time to do it. And now is the time to do it. Even if you're not a $50 million business, if you're a $5 million business, you still need to do planning, estate planning, and then the exit planning, figuring out how you're going to get there. Are you going to sell? That's what you and I do a lot of, but it's
Right.
not just selling the business to a third party. It might be engineering a sale to your management team.
Yeah. Or generational, right?
That's right. Or
Which
to the family. That's right.
awesome. Awesome. Well, hey, Wayne, if you were going to hire a CEO to take the reins for your company, what's the one book you'd require he or she read before taking over?
That's a setup for me. I mean, I'd have them read your Multimillion-Dollar Exit by Wayne Zell. But
There it
if they
is.
don't want to read that, because it is 365 pages without the executive summary and the glossary, which is even longer. It's a long book, but it's got a lot of stuff in it. Another book that I recommend is Gino Wickman's book, Traction,
Action.
which
Fantastic.
builds the entrepreneurial operating system. And a lot of people use it. We use it here. And I think it's a very, very well-written book, and it's built on building processes, getting the right people in the right seats. It's all the same stuff that we learn from other places. I think
Oh,
he's
yeah.
done a really good job of articulating how to operate a closely held entrepreneurial business. That's one I would recommend as well.
Love it. Love it. Yeah. Great book. Fantastic book. Um, so many great nuggets here, Wayne. I want to take just a few seconds and summarize some of my key takeaways. One was why are we even exit planning is and that's start with the end in mind. You have to be very intentional about what you want, or else you'll never get there, or you'll never know when you get there, right? And also really thinking about the unexpected. The other one, which I thought was a really good one, was is it when we're looking at maximizing the value of the company, we have to fill in those value gaps. And just some of those tangible value gaps that we were giving out, which is great information, is you have to have that management team that can run the company in place and have them be motivated, retention bonuses, equity, whatever that is. Something that differentiates you from your competitors, a unique value proposition, operating systems, processes, policies, things that all healthy companies that run a turnkey operation, right, without you is very, very valuable and helps you increase that value. The other thing I thought was good was the economic downturn. Just really, really focusing in on, just because there's an economic downturn doesn't mean businesses are selling. They're absolutely selling. And there's still, it's a little bit less of a price people can pay because interest rates are up. But there's even ways to negotiate and make up for it, right? So, and the last one I thought was a great takeaway was anybody out there a revocable trust transferring. I think that's genius. Transferring a certain portion of your company into some trust vehicle that obviously you would recommend, and the millions and millions and millions that could be saved at currently as a tax strategy around that. Um, Wayne, if I could ask you, what's if there was one takeaway that you'd really want the audience to absorb from our time together today, what would that be?
Start your exit planning now.
Love it.
Just start it now. Whether you use us at aspiretoexit.com or zelllaw.com, or you use somebody else, start your exit planning now and have your estate planner work with your business lawyer who works with your CPA,
Create a
who
team.
works with in a team, who works with your insurance expert, who works with your financial planner. And I do this all the time in teams. And I have to say, yeah, it may be a little more expensive up front. It's totally worth it, because what you're doing is you're building a team, an advisory team that's going to help take you through that exit and help you build the best company that you can build for yourself, for your family, for your employees, for your clients and customers. It's really important. So do it now. Start now. Don't wait.
Love it. Wayne, and so what's the name of your book one more time if anybody wants to go grab it? It's on Amazon, I assume.
It's on Amazon, and you can also get it at my website at waynezell.com, and you can buy it on Amazon. Here it is, your multi-million-dollar exit. That's what it looks like.
There you
And you can get it in hard copy, you can get it in paperback, you can get it in Audible. I did the narration for the Audible. That was a lot of fun. That was my singing prowess that allowed me to do that. I didn't sing in the book, but it was a lot of
Yeah.
fun. And it's also available in ebook on Amazon. So
Okay, cool. And that's Wayne Zell, WayneZell.com for anybody
or
listening.
yeah, or on Amazon. And if you buy it on Amazon, leave us a 5-star review so that
There
we
you go.
can keep growing the culture around this exit planning concept. Because there was a great book written by John Brown about 20 years ago, 25 years ago, on exit planning, but he never updated it. And it's like, okay, things have changed, times have changed. I have my own stories. These are my stories of clients who I've dealt with over the decades that I've been doing it, and I highly recommend it. Um, Clients are loving it, and they're hiring us to do all kinds of stuff, and it's not just legal stuff. It's business exit planning. So we'd love for everybody to get a copy if they can of the book. So
Awesome. Fantastic. So they know where to go to get it. Go. I highly advise especially after talking with Wayne on the show, he knows his stuff. So check him out. Awesome, Wayne. Thanks again for being on the show. This was a fantastic episode.
Patrick, thank you so much for having me as a
Yeah,
special
man.
guest on your podcast. I really appreciate it.
You bet. And for the listeners out there, please hit the like and subscribe button and help us spread the word about what we're doing. We're helping the next generation of leaders and CEOs be that much more successful. With that, this is your host, Patrick Rogers, and we'll see you in the next episode. Thanks a lot.